You filled up your tank last week, paid whatever it cost. That number on the pump is running through every single business in the country. Right now doing math, and the math isn't going well. Here's the thing about oil. It's not just fuel. It's the cost of making almost everything. Plastic comes from oil, fertilizer comes from oil, the rubber on your tires comes from oil. Getting any of that from one place to another burns more oil. So when oil gets expensive, it's not one price going up. It's 1,000 prices getting nudged at the same time. Not immediately, not all at once, but businesses know it's coming before you do. That's the part that moves markets. The stock market is not the economy. It is a room full of people betting on what the economy is going to do next. When oil prices spike, those people update their bets fast, not after earnings reports, not after quarterly statements. Right now, while the price is still moving, the update goes like this. Higher oil means higher costs for every company that makes, moves, or sells anything physical. Higher costs mean lower profits. Lower profits mean the stock is worth less than we thought this morning. Sell, not tomorrow, now. That's the drop. That's the mechanism. It's people repricing the future before the future arrives. But a crisis doesn't just raise oil prices. It raises uncertainty. The market hates uncertainty more than it hates bad news. Bad news you can price in. Uncertainty you cannot. So the market does what anyone does when they don't know what's coming. It pulls back. Hedges, waits. The whole thing dips just from not knowing how bad it might get. There's a specific type of business that gets absolutely destroyed in this environment. Airlines, trucking companies, cruise lines, manufacturers, any business that already signed contracts, already promised prices to customers, already ordered inventory, the one that already bought the supplies and already told shareholders what the margins would look like. Congratulations! Your cost structure just changed retroactively. Have a great quarter. When those companies warn investors that profits are going to be lower, stocks fall. When stocks fall, people feel less wealthy. When people feel less wealthy, they spend less. When they spend less, more companies miss their numbers. A feedback loop that started at a pump somewhere and ended at someone deciding not to buy a couch this month. Oil price spikes also mess with the Federal Reserve. The Fed watches inflation like it's a part-time job that became a full-time personality. Oil goes up, inflation goes up. The Fed raises interest rates. Higher rates make borrowing more expensive. Less borrowing means less investment. Less investment means slower growth. Slower growth means lower stock valuations. Oil didn't just hit companies through costs. It hit them through monetary policy too. Double tap. When oil spikes from a geopolitical crisis, investors rotate out of stocks and into things that feel safer. Gold, treasury bonds, things that don't depend on the world cooperating. That rotation alone pushes markets down, even if nothing fundamental has actually broken yet. The market moved on vibes. Expensive, well-reasoned vibes. But vibes? So what happened? Oil got expensive, companies got squeezed, the Fed got nervous, investors got scared. Everyone repriced the future at the same time. The market fell. It's not irrational. It's the market doing exactly what it's designed to do, incorporating new information as fast as possible. The problem is the information arrived as a crisis, and crises don't come with instruction manuals. Oil hits costs, rattles the Fed, and spooks investors all at once, sometimes before anything actually breaks. The market isn't panicking, it's doing math. The pump price was the first sentence. The market drop was just the paragraph finishing itself.